Hello everyone, my name is David Preston. I'm the Director of Investments for First Bank Wealth Management. Today I wanted to provide some perspective on the stock market as well as provide a little recap from last year. We had quite the contrast in 2018 versus 2017. In 2017, virtually every major stock index was up, every month was up, and it was one of the least volatile years in history. However, last year was a completely different story. In late September, we had hit a new record high on the stock market, but then a litany of issues began to crop up, including trade worries, concerns the Federal Reserve would raise interest rates, concerns over potential global economic slowdown, as well as continued drama out of Washington. As a result, this led to a sell-off in stocks in the fourth quarter. In fact, it was the worst December since the 1930s, and the S&P fell about 15% from its highs. So as a result, we've seen some headlines from the media, which has done its usual job of trying to scare investors as much as possible, as you've seen such words as plunge, bloodbath, or crash. But let's put things into perspective. Since this bull market began in March of 2009, the S&P 500 is up around 350%, making it the third strongest bull market in history. Last year overall, the S&P 500 was down about 4%. Bonds were able to eke out a small gain as they rallied late in the year, offsetting some of the drop in stocks. So an overall balanced portfolio, depending on your actual allocations, you were probably off in the range of low to mid-single digits. So not exactly a financial catastrophe, much despite what you hear from the media. With last year's decline, stocks are still up 14 out of the last 16 years. Now, it's normal to have periodic declines. Stocks don't always go up. Since the bull market began in March of 2009, we've had 23 declines of at least 5% and 8 declines of at least 10%. Also, the daily swings in the stock market may seem scary at times, but the actual percentages aren't that great. If we look at the daily changes last year of at least 1 or 2%, 2018 wasn't that much different than the long-term averages. As shown by this chart, there were 64 days last year where we had a change of at least 1%. That compares to the long-term average of about 59 days. And we had 20 days greater than 2%, again close to the long-term average of about 17 days. So where do we go from here? Well, there is a chance this could turn into a bear market, which by definition means a decline of greater than 20%. But not every 20% decline has led to a recession. Since the 1920s, there have been 21 declines of 20% or greater, and only about half of them actually led to a recession. Of the 20% plus declines which did not lead to a recession, stocks fell on average about 29%. When we did go into a recession, stocks fell on average about 40%. So if we do go into a recession, we still have further declines ahead of us, but if the economy continues to grow in 2019, which there is reason for optimism it will, then stocks should rebound. At this point, when predicting the future, there's always uncertainty. That's why you should have a well-balanced, diversified portfolio that's designed to weather any storm on the downside, as well as provide you some upside when the market conditions are favorable. If we look at history, how a well-diversified, balanced portfolio has done, it had 60% in stocks and 40% in bonds. As shown by this chart, you've weathered different crises in pretty good shape. On average, you've been up after 5 years in the 50% range, and after 3 years, about 20%. So my best advice is turn off CNBC, don't worry about the daily action in the stock market, but instead focus on your long-term plan and have confidence stocks will eventually rebound as they have after every other decline. If you have any questions or further comments, please email me at david.preston@fbol.com. Thank you very much.